Hello and welcome. I'm Alex Proimos, Head of Institutional Content and Investment Magazine, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to check out our website, investmentmagazine.com.au, and subscribe for a free email. And with that, please enjoy this week's episode. Well, Nick Kelly, Head of Research, Willis Towers Watson, thank you very much for joining us today on Market Narratives.
Thanks for having me, Alex.
So let's kick off the discussion around a paper that Willis Towers Watson has just put out, which is around the 20 years of manager research and the evolution. I'd like to sort of get your background in terms of how you've seen the teams change over the last time that you've been at Willis Towers Watson.
Yeah, sure. So, I mean, we have seen considerable development and evolution in investment teams within investment managers over time. I think managers have become more accustomed to dealing with a broader array of clients and investors. And so, therefore, the teams have had to sort of evolve over time as well in respect of that. In some asset classes, there have been significant, there's a number of asset classes which are relatively new, right? So take private debt as an example. That's only really evolved over the last 5 to 7 years. And so many of the teams there are sort of being pulled out of banks. And so the way in which they're operating is very different to a banking environment, right? Where instead of that environment, you're now managing third-party capital. And so I guess the evolution that comes with that, how teams operate, and I think an understanding by investment managers that they need to tailor products to the needs of to their clients. Right, that one product doesn't suit all, and so there's a requirement to be really flexible in the way in which they deal with clients.
I'm curious, when you're looking at teams that have been now sort of spun out of a bank, for example, versus built up on their own, and they've created their own management firm, investment management firm. How much do you see a difference in the type of people that are coming out of a bank, for example, in terms of particularly entrepreneurialism, the innovation, and even maybe potentially performance?
Yeah, it's a really good question. It differs quite considerably between organisations, and often it could be a manager that sort of, has a small presence in one asset class and then has effectively pulled a team out of the bank to run a separate strategy. And so then the question becomes, well, that team had its own sort of culture and their own sort of skill set, and how does that mold into the new organisation? Is it going to work? Are they well aligned? And so I think we do see, asset managers take their time with those sorts of acquisitions and pulling teams out, and that just ensuring it is going to work. It's got to work for both parties, so that there's the sort of financial metrics of the transaction, but there's actually the long-term success of it, whether there's the appetite of the team to come across and how that's going to work in practice. And as you said, is a team that's being pulled out of an organisation like a bank going to have the sort of entrepreneurialism that someone that's founded an asset management organization is going to have? Do you want that? In some cases you absolutely do. In other cases, depending on the strategy and the skill set you're looking for, you may not. You're looking for something very different, right? And so it's sort of the combination of the two and how it's going to work in practice, and whether the cultures are sort of sustainable long-term together is probably the key thing.
The other challenge that sort of comes to my mind is that because asset managers are trying to diversify their strategies, they're looking to diversify their revenue streams, they're moving into more and more asset classes, but there's a lot of technical skill that comes alongside moving into different asset classes. How often has that been successful?
I would say a small number of cases where it has been, to be clear. Our view is you need specialist skills to operate in asset classes. Right. And so our preference is tended to be work with managers who operate more sector focused strategies, where there is that specific skill set rather than the sort of broad multi-asset focus. And I think that the other challenge that we've seen over time is that if you think about the evolution of an asset manager from the point at which they're sort of founded, and there's maybe a couple of people, including the key investment professional, investing capital to, over time, getting bigger and bigger, increasing FUM considerably, and then getting a much bigger team, is they move or morph from managing investment risk to effectively managing business and enterprise risk. And that's a real challenge in the sense that often when you're going to invest, you're trying to tap into the investment risk piece, right? And so therein lies the challenge of actually trying to isolate the skill that we're trying to the piece of the puzzle we're trying to pick from that manager, right? What role they're going to play, right? And so often it's actually working with the key investment professionals to structure something very bespoke to say, we want to tap in to your expertise as an investment professional. We don't want the big multi-asset strategy that is the vast majority of FUM of the organization, because often there's not sufficient amount of risk being taken in that strategy, right? Because all it is doing is supporting the big beast of the business that is now being built. We want to isolate the skill, and often what that investment professional did, 15, 20 years ago when they founded the firm, right? But over time, their role has changed. They're now managing people. They're managing a business. They're not just managing investments.
I think it's a real challenge for many of these managers as they grow. Initially, it's a couple of people, maybe 3, 4, 5, and they're really focused on the investment piece. As they grow, it then becomes this business. You need marketing, you need distribution, and it starts to sort of lose its focus. How much do you then sort of try to work out? Do they have the right operational people there to support the investment people, or should the investment people be alongside the distribution people? How do you think about that balance?
Yeah, that's spot on, and it is hard. And often the key investment professional, ends up in that role as sort of the head of the business or CEO, but it's actually not their skill set. Their skill set's investing capital, right? And so it's actually, now some people can do it, but some are better placed actually having the business management support alongside them whilst they still retain, the overarching sort of decision-making around investments. The operational support piece is absolutely critical. I think, much like asset owners, particularly in the Aussie market, given the raft of regulations we're facing, that has hit asset managers too. Right, they've got bigger ops teams than they've ever had, more reporting teams, more distribution channels, given the sort of broader array of client base that they've now got to deal with, right? And so that ops piece is really important. And so, we often think about regs and what's facing asset owners and superannuation funds in particular in the Aussie market, but that has flow-on effects to the asset management community as well.
I want to come back to one other thing which you were talking about in terms of the types of strategy and making sure that they've got specific skills. One of the other areas is around sort of geographical skill. Investing in private credit in Australia versus the US versus parts of Europe is very, very different. And so how do you also make sure that these firms or these investment management firms are not sort of straying too far out of their comfort zone?
At the end of the day, it's assessing the team's skill set with respect to the opportunity set that they are going after. Right. And so there needs to be boots on the ground in those areas that they're targeting. Right. And it's going to be a very different set of individuals, a different skill set depending on the strategy. I mean, you take private debt as example, right? You've got middle market corporate direct lending in the US is a very different skill set to doing infrastructure debt in Australia, real estate debt in Europe, distressed credit in, the Nordic region, for example, right? Like it's just such a specific bespoke skill set that you're trying to look for, and there's not one group that can do it all, right? And so it's having the boots on the ground and the right team on the ground with the right networks to be able to deliver on that strategy. But it is important because some areas will become crowded, right? And managers will look to other places where there might be a particularly attractive opportunity, right? And we want them to do that. We don't want them just investing because, well, that's where they've got some people and now there's a raft of other people coming in. And so it's now more competitive and therefore less interesting from an opportunity perspective. But importantly, if they're going to broaden maybe their remit, whether it's a strategy or geography, there needs to be the team that comes with that, right? And so it's ensuring that they've got the right skill set, the all-round skill set to be able to go and deliver on it if it does broaden. That
makes a bit of a challenge, obviously, for you and the team around sort of crowding in asset classes. How do you then try to find the managers that will outperform, particularly as you're not just looking at the investment team, but you then need to think about the market that they're investing in? And I think that's a real challenge.
Absolutely. And you see this a lot, right? When certain areas of the market become frothy because there's a particular focus on it from a range of investors. And so all of a sudden there's managers, queuing up to raise capital to try and deliver on a strategy. And so it's one, trying to find the right group that has the sustainable competitive advantage over the others. And that comes to the process that we have where we look across 6 key success factors to have a view on skill and sustainable skill and be able to deliver that alpha over the long term. But also look at the opportunities where maybe others aren't looking at, right? And we had this situation in Australia 5 or 6 years ago where we did a bunch of research on healthcare real estate, right? And we saw healthcare as, trading sort of 200 basis points above on a risk-adjusted basis in terms of cap rates. And it looked really, really attractive and no one else was doing it. And so then we went about trying to find someone that we thought could go and deliver on it. Now that the number of groups operating that could deliver on at that point, a very small number, right? It's a much bigger number now because it's become a bit more competitive as others have come in. But there's that first mover advantage in looking at a broader sort of opportunity set where others maybe aren't as focused, or, often the argument of, I'm not sure where that fits. If I hear that, I'm like, okay, now I want to know more, because it probably means there's less people looking at it. And so they're the sort of strategies to actually have a think about what we can do in terms of working with asset managers to create sort of a bespoke solution for our clients, to target a specific opportunity set where obviously they need to have the skill to deliver on it, but there might be an opportunity there that others aren't looking at.
I'm curious whether you see asset owners that are asking for those sort of specific niche strategies to be developed for them, rather than the traditional just standard products. Here's the product, here's the fund, invest.
Yeah, I think there's been a growing demand for that as yields have come in and markets become more and more competitive. There is a growing desire to access these parts of the market. It is probably more driven from our sort of research team that's linked in around the world, rather than specific clients saying, I want healthcare real estate. For in that case example, that was driven by us looking at healthcare, thinking, actually, this looks really, really attractive relative to the core sectors. Why are we not allocating here? What role can this play in a portfolio? Then educating clients on the role of that asset class within property, finding the right group, spending the time with them, and then developing a strategy from scratch and seeding it with our client capital. So it's typically the relationships of the manager research team that's driving some of those initiatives. But on occasion, I think, when I've spoken to clients about that, what we're doing, they get it. It's like, yes, that's exactly what, we want you doing, right? That you're the engine, you've got the relationships on the ground with 90 researchers around the world to go and do this, as opposed to just taking the stock standard product that an asset manager puts on the table, which is often, as I said, they put that on the table. That product is often to manage business risk, not investment risk. And they can raise capital for it. Okay, well, let's isolate the very best of that strategy and where they have a specific skill set and go and create something bespoke with them.
Let's come back to culture, because I still think this is a key piece to performance in these funds.
Yep.
A lot of the funds have got some key figurehead, a key CIO that leads the business. That's also very risky in the sense that they become, almost this dominant figure in the market that is calls the shots. They're used for marketing. They're rolled out everywhere. But it's also very risky because there is key man risk now. How do you think about that issue versus the broader team of these organizations?
Yeah, so it's a really good question, and it's something that's, when we talk about the evolution of our process, it's something that has evolved considerably over time. So we now undertake specific culture reviews with managers, and we effectively look at three key things: the employee value proposition, the client value proposition, and leadership. And those three things lead to an outcome or our view on culture. And culture is often defined as, the way we do things around here. Right. And there's no one culture that fits every organization. I mean, there's plenty of studies done on Bridgewater and their culture of radical transparency, which, might work for them, but isn't going to work for everyone. Right. And so it's finding that sort of, that secret sauce, if you like, with respect to culture and leadership and owning it and running with it is probably the most important thing. But most importantly, it's got to be an inclusive culture that values the opinions of all within the team. It's leadership that understands the team, mentors the team, challenges the team, but it has to be inclusive, cohesive, and fair, right? At the end of the day, that's what we're looking for.
There's some great words, but I think the challenge is getting them to work in practice.
Yep.
Being inclusive can also mean ostracizing certain people. How do you make sure that you work out almost the meritocracy of the fund so that the right people are getting promoted, right? It's very easy to get everyone to always have a say, but at the same time, you want to make sure that it is beneficial to the underlying process and the performance of the firm.
Yeah, I think fundamentally, you got to spend enough time with the organization, right? You're not going to come up with a view of that meeting a manager a couple of times. Right. It's as simple as that. And that's why we spend somewhere between 6 and 12 months with managers and researching strategies in extreme depth before we have a view on whether we want to back them. Right. And that you form that view that you've just talked about by spending sufficient time with them, sitting on their investment committee, watching the debate, watching how they include the team. When we do the culture reviews, we have a broad we've obviously got the leadership team in the room, but often what we'll then do is, then take the CIO out of the room, talk to the team, maybe then take the PMs out of the room, talk to the analysts, or vice versa, just have the CIO, right? And so you're trying to get a sense from the entire team as to how it actually works in practice, and not say something because the CIO is in the room, right? It's actually getting the various opinions and trying to form up that view over time based on our interaction with the manager as we've developed that relationship to say, does this, they might have said all those words that I said before, but is this actually how it's working in practice or not?
I think that's a really interesting evolution of research, and it's always tricky because people are always paranoid about their job and paranoid about, am I going to get found out, and so forth. So, how do you maybe look at other areas such as incentivization of employees, sort of seeing whether they're aligned with the company or the CIO? How do you look at those sort of areas?
It's a good question. So one of those, I talked about those 6 success factors that we look at when we're researching strategies to derive sort of our qualitative assessment. One of those areas is alignment. And the way I think about alignment, I tend to think about alignment as 3 key things, right? So it's equity ownership or ownership of the organization. Secondly is the fee structure, and in particular performance fees, which by the way are just an option on the upside. Thirdly, how much of the, what portion of capital is the team investing in the strategy? And importantly, how material is that to their individual net wealth? And it's those 3 things in combination, in my mind, that gives us an assessment of how well aligned the individual team members of an asset manager are to our clients. And so that's sort of how we think about it. But it is very much the combination of those 3, right? So you can have an organization where the team are, putting a chunk of their capital to work, which is probably the most pure form of alignment, but equity ownership might be a bank-owned asset manager, which we know is fraught with challenges. And we've seen plenty of blow-ups in the past with that sort of model, right? And they might also have a horrible fee model. So you're sort of sitting there going, hang on, does this actually work? Is this going to stack up? Are they well aligned to the outcomes? Are they going to be there for the long term? And it's not just the incentive program, it's the broader employee value proposition that we talked about before that can create some of that alignment and loyalty to an organization.
I'm curious as to how do you see a difference between that alignment in some of the very large, bigger brands that we all know in asset management versus maybe some of the smaller, more emerging managers?
Yeah, it's a good question. I would say it is very different manager by manager. I think with some respects, it can be easier with some of the small emerging ones because of the equity ownership piece can be easier to manage if done well early on. That said, there are ways of having sort of long-term incentive plans, equity share plans in place with larger organizations. So I think, often what you see is it can at times be an afterthought, and, an organization manager might grow, might lose some staff and then sit there and go, hang on, we need to do something, right, around retention. And then you're trying to develop a plan from there. And it can become, it's not an easy one to get right, to be clear. And as I said, because it's a combination of all those factors that comes into play. So I would say in some respects, it may be a little easier for some of the smaller ones to sort of get it right from the start, as opposed to the larger ones where sometimes it could get lost. That said, we have seen large organizations deal with it well through LTIP programs, employee share option plans and the like, to try and create a stronger form of alignment longer term. And also the benefit of a larger organization, if they've got more FUM under management, then fees can often be, we can sharpen the pencil a bit more, as opposed to a startup organization, which is still building out its back office and things like that. Yet the startup one is probably more hungry, right? And so it's trying to marry all these together to get the right outcome. As I said, fundamentally, when we're doing this, we're thinking about our end clients and whether this manager is well aligned to the outcomes that our clients are going to get.
How does the process of this evolution of researching these funds change in the sort of due diligence stage, pre-investment, and then post-investment, sort of once the firms have invested? How does that change? How do you then sort of what are you looking for? What particular areas do you narrow in on, say, post-investment?
It's a good question. So I think post-investment, probably the key thing is, ensuring the engagement levels are still there, right? Now they've got the capital, are they still engaged? Providing the adequate reporting. We've seen as we talked about regulations before, but also sustainable investment reporting on culture, new additions to the team. So that aspect needs to be retained. I would say any form of style drift. Right, so we're back to strategy that's planning to do A and B, and they're now doing C. And we actually had this as an example more recently in the Aussie market, a private market strategy, whereby they sort of went in targeting both social infrastructure and renewable infrastructure deals, but was probably more, and probably, initially when we were undertaking the due diligence, it was the renewables space was particularly attractive. By the time we'd sort of completed our due diligence, we got comfortable with this manager, which was a new emerging manager, that space had become very, very competitive. And so I think some clients probably thought, well, it's going to be a heavy renewables allocation. It's ended up just being social infrastructure. Now, had they invested in renewables, they probably would have raised more capital, because it's a space that everyone understands and gets. Yet the performance has been absolutely stellar because they didn't do renewables because pricing just got too rich, right? And did some social infrastructure deals that are wonderful deals, but it didn't marry up with necessarily what was put on what I think I'm getting, right? And it is important to understand what you're getting because it is in the context of your overall portfolio, right? It might be that you've already got social infrastructure elsewhere. I was like, well, hang on, I was trying to buy this, not this. But equally, we don't want managers just to go and buy something because they've said they're going to do it if that space has got particularly expensive, right? So we want them to steer away from that area. But equally, you don't want pure, massive style drift where they're not doing what they said they were going to do and they don't have a skill set in doing it, importantly.
It's an interesting question around red flags, and that's potentially one, which is style drift. What other areas do you look at? Is it, for example, moving from, we've seen in a couple of cases, there's a few managers where they've done a lot of listed equity or listed fixed income and then started to drift into the illiquid space to juice up their returns. What other red flags do you sort of see that are concerning?
Those, exactly what you've just talked about. Any sort of rapid growth in FUM. And you see this with, in private markets with closed-end funds, maybe the first fund was 200 mil, the next was 500, and then the third's 2 bill. You're like, okay, hang on. You expect it to be bigger, but what is an appropriate jump, right? Do you have the scale to execute on something like that? And now you're playing in probably a much more competitive space. Turnover is obviously key. Remaining close to the team and ensuring they remain incentivized for the long term. And there's not just a bunch of carry they've been paid out. And so they're like, okay, I'm off, I'll go start my own thing. Geographical sort of breadth in terms of looking at strategies elsewhere in the world, as we just talked about. Those are probably all the obvious ones, right? But I think most importantly, it's maintaining a very close relationship with that manager that you've built up during the due diligence period, but remaining close post. Understanding the deals they're doing, what they're looking at, why they're not looking at certain things, how many things they've said no to, changes at committee level, other roles that, some of the independents have taken on, ensuring there's no conflicts. How are they thinking about diversity in their team? What's their recruitment plans now that they've got capital? They said they were going to recruit. Are they recruiting? Who are they recruiting? Are they the right people? Is there enough challenge? All the things that you sort of looked at through the due diligence period, you continue to look at, right? Because often at the end of the day, we've retained a rating on that strategy. We now need, it's not just a one and done, right? We need to continue to have a view on it. And if it's a closed end strategy, they're going to come back to market. Are we going to back them again? We're going to do full underwriting again. So we need to be comfortable that they're still skilled, right? And we still want to back them.
That's the other challenge around the skill, the alpha, and whether they actually have a competitive advantage to deliver alpha. And I think that's going to be, it's very easy to tick all the boxes and make sure everyone's doing the right thing. They've got the right incentivization, right retention, right leadership. But how much does that opportunity for them to hit alpha in their particular given sector, how much does that play as part of the whole manager research process?
Yeah, it's absolutely key. And that, our process has evolved over time, but fundamentally, it's those 6 success factors, and it is qualitative research supported by quantitative analysis. Right, there's a whole raft of statistical evidence that will tell you that looking at historical performance is not helpful, because often we'll pick someone that's performed well, you'll then appoint them, they'll subsequently perform poorly, you'll sack them. And we've seen this time and time again, and there's survivorship biases and there's all sorts of challenges with that model, right? And so whilst you can have, as you said, the right team, the right alignment of things, one of those success factors is opportunity set. Are they playing in the right space, right? Is it too competitive? In which case, well, sorry, we're not there. So it's got to be across the board. It's got to stack up. Or you might have, there's plenty of situations where you might see an attractive opportunity set, but not find the right group to partner with because they don't have the right team. They don't have the right alignment structure. They don't know how to manage a portfolio. There's been too much turnover, whatever it might be. So it's the combination of those factors that leads us to a view on whether that strategy and that manager is going to be able to deliver sustainable alpha over the long term. We're long-term holders. This isn't a short-term decision. So we need to get comfortable. And that's why our focus is very much a depth over breadth model for that very reason.
You mentioned a little bit there earlier around the quantitative and qualitative research that you do. We've probably seen a number of new managers coming in, or manager research firms come in that have got really strong quantitative approaches and trying to identify not so much the past history, but sort of understand the trades that they're doing. How does that line up with their underlying strategy, their research process? How much do you think quantitative research plays a role in managing, doing this manager research?
Yeah, I mean, it absolutely plays a role, but it's clearly not everything. if I think about, so my background is private markets research, but if I think about our equity research team, they will put, the manager portfolios through our variety of quant tools to see how trades have been undertaken, what style they're looking at, has there been style drift, where the concentration is, active share, tracking error, et cetera, right? We've got all that data. They'll do that ahead of a meeting to then go in and quiz the manager on what that quant information is telling them. So it's the qualitative assessment supported by that quant analysis, right? It's not quant that then drives decision making with a little bit of qualitative overlay. It's fundamentally a qualitative decision, but it is supported by strong quant. The quant will always be there. Right? If we're looking at private markets, it's looking at track records, it's looking at the sorts of assets they've invested in, when they deployed capital, when they chose to sell assets, or did they try and hold on too long? What sort of operational improvements did they make to those assets over time? So there's a very detailed assessment that's undertaken on the quant side of things, but fundamentally it supports a qualitative assessment. And those things need to marry up, right? Because a quant can tell you one thing and then you're into conversation with them going, hang on, this isn't making sense to me. And that could be a style thing or a change in opportunity set or where their focus has been. But it is fundamentally, it's a qualitative assessment with that quant support, which is important.
I think it's interesting that we've seen a number of groups that are using quant research really just to narrow down the amount of managers that they're looking at and try to find who's different.
Yeah, and we're doing that as well, right? We have a tool called a structured assessment method, which effectively does that, right? That gives us that breadth piece, right? To then say narrow down strategies. But that said, there needs to be, the way in which we, people often say, where's the idea generation come from, right? And someone unhelpful answer is it can come from anywhere, right? So it can come from that method of using something like a sort of quant tool to narrow down the groups that look really attractive on paper that you then want to dig into in more detail. But it can also be relationships we've got in the market. We've all been researchers. We've got a very experienced team of researchers, some with 20, 30 years experience, right? So they're going to have relationships with lots of people in the market. So someone's going to call them one day. I had this back end of last year, someone called that we've not backed before, but I've known for 5 or 6 years and said, look, I think you should have a look at childcare as a space in property. And I was like, okay, let's have a look. Now, we're not going to get there at the moment for a variety of reasons, but it's those sorts of conversations is often where these ideas come from, groups that we probably might not have done something with, but have wanted to, or with that group, we actually wanted to do something with them and they didn't want our capital, which I always view as a very good thing because they just didn't think it was an attractive opportunity 4 or 5 years ago. All right, when people do that, I'll listen and we'll stay in contact. And so if something pops up in the future, we might be able to partner with them. That's they're the sort of group. So those ideas can come from, as I said, that sort of quant tool to narrow it down or relationships in the market. They could come from clients. I mean, it can come from a variety of areas.
Now, we can't have a conversation about the evolution in manager research without talking about sustainability and ESG. It's everywhere.
It is
I guess
everywhere.
the biggest concern is greenwashing and actually understanding what's being done is true sustainability. And sustainability means many things to different people, right? It could be financial, systemic risk, it's climate, it's governance. There's a lot of issues. And so how do you sort of break that down to actually work out whether a manager is actually doing what they're professing to put on the label?
Yeah, it's a really good question. We have and this is one area that has evolved considerably, right, for obvious reasons. And given recently made a sort of net zero pledge for our entire delegated portfolios globally by 2050 and to halve emissions by 2030. We've made a fair bit of progress in that space already. I must say, as a researcher, it is ingrained in what we're looking for. And to your point, it's not the strategies that are blah, blah impact fund, because often those it's just a labeling exercise from a business development perspective. They can be, but my point being that there's plenty of funds that profess to be impact that are not, and there's plenty of funds that don't have the word impact in their fund name that are driving an impact. And so it's really about looking under the hood and understanding what the strategy is, what they're targeting, and the belief system of the manager and what they're trying to do, and whether there's sustainable alpha in doing that. But it's a combination of all those factors. Our sustainability questionnaire has evolved over time to help us drive some of this. We provide a rating across E, S, and G, across all the strategies that we rate, and we'll monitor that over time. And that questionnaire that we use with managers has evolved considerably and is now far, far longer to the dislike of many of them that has been in the past. But it's because it is so important, right? And we do think there's going to be real alpha opportunities, particularly in the short to medium term as the repricing happens. So there's one better alpha opportunities, but there's also better beta, right? So things like stewardship is absolutely critical. We're stewards of capital at the end of the day, and there's a role that we have beyond the strategies that we rate within the industry as a whole to improve this transition that we're seeing.
It's a really challenging time because I think nobody will put their hand up and say, look, I'm against stewardship, I'm against ESG.
Yep.
No one will say that because no one wants to be ostracized and everyone wants to do the right thing.
Yep.
But there is a real challenge around fiduciary duty and returns. And sort of what can you do in different sectors of the market? There's different asset classes where I think stewardship is difficult. And so how do you sort of think about different parts of the portfolio as to what you can do today versus what you can do in maybe 15 years or 10 years or 5 years time?
Yeah, absolutely. I mean, it is, you take equities versus credit, for example, what you can do from a stewardship perspective and where credit managers are relative to equity managers. They're probably more in their infancy on that journey in what they're trying to do, but therefore, we can focus on sectors. We've done plenty of things in credit on affordable housing, for example. So the S piece of ESG. G is always fundamental, always been a key part of our research process has been the G piece. If I think back to probably the last 20 strategies we've rated within private markets, so across real estate and infrastructure and natural resources, I'd say 3/4 have had a very strong E and S bent. We did a strategy that was an EV electric vehicle charging station strategy in the UK, rated a strategy the other night, which is a forestry strategy, planting trees, which is effectively carbon capture. Now, the fund names don't have impact in them, again, to my point, right? But there is a clear environmental benefit of these strategies, and we think in the short to medium term, they will deliver because of a repricing that's happening. But it is, you're right, you need to look far and wide. You need to absolutely take into account, the fiduciary duty piece, right? These need to deliver high risk adjusted returns, right? We're not just putting capital to work and pay high fees on something to deliver an okay outcome just because it meets E, S, and G. That's not what we're looking for. Fundamentally, it has to stack up on a risk-adjusted return basis, but there's plenty of things that you can do that tick all those boxes and have a strong bent towards sustainability.
Well, I think that's a perfect place to leave the conversation. Thank you very much for your time today, Nick.
My pleasure. Thanks, Alex.
Thank you for joining us. All views expressed on this podcast are subject to change and do not necessarily reflect the views of Connexus Financial. This podcast is for educational purposes only and should not be relied upon as investment advice.